Ladies and gentlemen, welcome to the 14th episode of the Futurum Equities podcast. You got myself, the new Texan, Stock Savvy Shay. I'm in Austin right now. We got Daniel Newman, his hometown, Austin, and things are ripping. The market's ripping right now. I think every single day this week, it's just been up to the right. It's kind of almost like video game numbers, but how's life treating you, Daniel? I know you had some predictions that have hit this week that you claimed that would happen before end of September. So
we're getting there. We're getting there. But first of all, congratulations on your honorary role as a Texan. Good to have you here. You're in the right place in the right city. I don't know how you go back to California. But it's been a heck of a week. We knew going into this week it was going to be super interesting. Of course, there's always like the stuff is going to happen in a week. Like we knew FOMC was this week, and we knew it was going to be like this big potential rate pivot. We talked about it on our extra bonus episode on Monday. Mm-hmm. But then we didn't know, like we kind of knew that this UK thing was going to be something. So everyone was watching that there'd be AI announcements. So that was kind of there. But like the yesterday blow the roof off, Kingmaker Jensen makes the announcement about their partnership with Intel, like totally changes the news cycle. Creates a whole bunch of stir. A busy day for me. I think it was a busy day for you. The stocks are going up, and I stand by everything I said on Monday. Like, yes, things look great. Risk assets, great. Non-risk assets, great. But there's something like stirring in my brain. Like, can it be this good forever? But I did see that one tweet you put out about, that all the people that had doubted your growth mentality in AI. And my God, like, we get a 10% pullback or even a bigger one. Like, I'm okay. I mean, we made that. We took the ride. I'm saying, like, you took the ride. Like, sure, somebody's right that we are due for a pullback and it might pull back. But like, so you went up 150% and then you give back 10 or 20. I don't know how you don't participate in markets these days. I just don't know how you can do it, because you're literally just, it's like when you buy a boat, you walk out to the end of the dock, you pour the money in the water, and you say, if that feels good. It's the same thing with being short. You just walk out, someone hands you a bag of money and say, instead of holding this, throw it in the water and see, do you like how that feels? Then you should be short. Because
I think it's just like, I don't know, this gets the ethos or vibes of this is like such a heated rally for some reason. It's been like that. I think a lot of people were clouded on geopolitical risks, what's happening on the macro fronts, and they're forgetting, or they're taking their eyes off the ball of, this is the greatest theme of our generation, AI. That is, Lisa Su mentioned it this week. You've been saying it for a long time, that it's so freaking early. The demand is insatiable right now for compute, and it's not going away anytime soon. Lisa said it's the second inning or second year of a decade-long build-out. I think that's accurate, and I think that's why you're kind of seeing it feels like all these names, these obvious names, continue proving why they are the obvious winners week after week, quarter after quarter. And yesterday, NVIDIA, Jensen, just literally proved to everyone again, you guys are all performing really well, but it's on our terms. We're going to remind you guys soberly that we can flip the script very easily if we wanted to. ARM Holding wanted to become less Switzerland and become more an AI player. I think that's a right play long term. I think that maybe incentivize NVIDIA more to work with Intel. Same thing with AMD, what they're doing on the rack side of the business. Probably incentivize even more for NVIDIA to work with Intel. And I think that Intel is like one of those assets where it's been poor corporate governance and strategy, and that's why they've lagged on the AI roadmap, but their positioning is elite. All they need is a thought partner. And they've had 2 thought partners now, maybe 2.5 if you want to call SoftBank one. But the US government and NVIDIA, I don't know of better thought partners to turn the story around. And I think you speak to Intel's management all the time. Like, can you sense a culture change a bit now that there's like a renaissance of excitement again on AI for Intel?
Well, they've made some really big changes. They Their product CEO, Michelle Holthaus, recently departed. They've added new muscle to Foundry. But remember, I mean, they've taken about almost 17 billion dollars in, 10% stake, 2% stake, another almost 5% stake. It was around 15 to 17 all in. Huge amount of capital commitment, confidence voting, kind of king making. Like I said, Jensen sort of did he put the crown on. If this is a checkers game, but obviously President Trump brought him right to the end of the board and like, hey, this company's going to make it. We're going to make sure this company makes it. Remember, SoftBank put money in, and it's technological in the sense of yes, like building systems and chiplets that would allow Intel x86 cores to sit with NVIDIA GPUs. They also made it. It also just absolutely created favoritism towards the enterprise because Intel has a ton of strength, 70% market share with x86 in the enterprise. And while AMD has made some headroads, this definitely is going to create a stronger position because the enterprise wants NVIDIA GPUs, but they need the CPU. They need x86. Before yesterday, it was really AMD that was winning more and more favor there. I'm not saying that's going to switch right away. Because remember, this is like 3 years before a part hits the market. So a lot of deployments are going to happen before this takes place. But it does give a lot of confidence. It does turn the dial. I do have a bit of a sort of subtle opinion that's maybe a little less obvious. And that's that more of these investments are about future foundry capacity and a subtle signal to TSMC about its monopoly and a strong signal to the administration about a desire to find a way to do foundry with Intel. And the fact of the matter is if this market grows as much as we think it's going to grow, we're going to need all the capacity we can get. So we're going to need all the capacity TSMC can offer, and we're going to need more capacity. And it's going to be Intel or Samsung are the only two real options at the leading edge to fill that void. So to some extent, like did Jensen put $5 billion down to say when 14A comes out, and if it's a usable part, we're going to want wafer. We're going to want wafer deals. ARM could have said the same thing with what it's trying to do, expanding into products, designs, and AI. I think there's more to this deal than just these 3-year out designs.
No, I think you're accurate in that sense, man. I think let's stick on ARM, for example, because I think ARM is probably, if I had to pick one name that this was the most polarizing with, it's ARM, because NVIDIA, like going on an x86 again, like NVIDIA and Intel essentially saying to everyone that in a couple of years you can sell AI laptops at scale without needing ARM's efficiency or expensive add-ons. And I think do you think there's enough time for ARM to become that AI player before that happens, so it doesn't really matter as much to them as now there's a new competitive headwind in that space that essentially they had kind of a monopoly because everyone started on Intel chips, but they left to use ARM chips. Do you think that's enough leeway for ARM to like really get lift off on AI where their CPU business won't matter as much because they're becoming such an AI player?
No, I mean, look, Jensen was very clear, and actually have had the chance to speak to execs at NVIDIA and ARM in this process. Jensen was very clear because first of all, remember, ARM dominates the Grace Blackwell, and then of course we're going to have Vera Rubin. This is the hyperscale deployments, the GB and NVL 72s. Like this is ARM is not going to get pushed out of this part. Okay, ARM also has a total moat on low power. So there's nothing in this relationship that's going to, on the handsets, smartphones. So this is really about the PC client and then the enterprise. Yeah. And so, we've seen ARM has made some good inroads in the cloud as well, like for individual use cases. You're seeing like AWS, I think it's like 50% now of AWS CPU instances are on ARM. So ARM's doing okay. I mean, there's certainly going to be some pressure on client, on PCs, because x86 still does dominate there. And if there was a part, there was supposed to be this NVIDIA ARM part early next year. That's going to be later next year. And that was really focused on the high end. But NVIDIA really only sells Ferraris. Mm-hmm. So they don't sell, GMs and even Tesla Model 3s. So this will fill in some of that void and give NVIDIA more exposure. But it's really more about NVIDIA competing with AMD. So it still to me comes down to this is more of a challenge for AMD. It's indicative that Jensen feels the threat of what Lisa Su is doing, and that he understands the positioning in the enterprise, which AMD has done very well with EPYC, is important, and also the positioning of GPUs in the enterprise is very important because there was probably more risk there when it came to private data center deployments.
Yeah, I mean, AMD, it's weird because Jensen and Lisa are kind of related. So there is actually kind of a sibling rivalry, but it feels like AMD was picking up some real traction, especially on a narrative. And I don't know why, but NVIDIA just wanted to stomp on that and prevent that momentum continuing. But I do want to ask you again as well, Daniel. There's been a new trend, though, that there's more and more equity stakes because this new digital economy, this AI, is truly national security component. It's an arms race. Do you think that some of the names that are like in the Intel camp, for example, the Qualcomms of the world, maybe the Microns, where they're undervalued, necessary component of what they provide in the new digital economy, maybe they get partnerships with someone like NVIDIA as well? Like, do you think this is like a new trend where government, NVIDIA, major players just start taking equity stakes in these kind of companies?
Yes. I mean, I actually shared this. I do think there's a very realistic chance. The partnerships are interesting. Will there be a wave of partnerships with Intel on the design side? I don't know. And I'm sort of interested in how all that plays out, and even whether there's some concessions being made by Intel about what it plans to design in the future in order to stay super friendly to NVIDIA in this partnership. On the foundry side, though, I'm going to say it again, like, I could see Broadcom, I could see Qualcomm, I could see Apple. Some of these big companies that do a lot of volume, I could see making bigger investments. We also knew that like Microsoft had parts they planned with Intel. Amazon had parts, like specialty chips that they plan to work with Foundry on. So I do see some of this proliferating, and I could see a bit of a line. Because remember, there's a certain part of this is kiss the ring of the Trump administration. Like, they backed, I mean, he did literally tweet, if I'm not mistaken. He tweeted out, what was it? Like, Intel now at 30. I mean, the fastest return ever on $10 billion of US equity investment, right? He's just returned $5 billion to the taxpayers. So this is what needed to be done. I mean, getting these companies to sort of come in behind, I think that's going to create some serious acceleration.
Well, do you also, I think some of the wonkiness of this market or the lack of September weakness, like we're not seeing any seasonality weakness this so far. I know we're not done with September yet, but it doesn't feel like we're going to get it. Is due to the fact of we have the Fed on our side. Liquidity is important.
What happened to that, Shay? What happened to September, go away for September or whatever, come back? Like, why are we not getting crushed? I mean, we're all supposed to get crushed.
I think it's because this earnings cycle, we finally got the validation that AI is very real and the impact on ROI is happening right now. I think we saw so many major players. We saw Meta have an insane bottom line beats. It was kind of crazy, the earnings beat. We saw reacceleration on Azure, Google Cloud at insane scale. They reaccelerated at a drastic pace. And then you're also seeing a lot of like these AI utility players just get massive deals all of a sudden, like the NBISs, the Iris Energy, and then you're seeing like Palantir continue to reaccelerate. So I think you're seeing how AI is just actually hitting the fundamentals now. And everyone knows the runway for AI is insane. Nobody knows the ceiling. You and like Futurum might be the most bullish of AI in the space. And we continue to constantly be reminded of how early and how insane the opportunity is. I think that everyone knows the runway is massive. And if AI is proving at this stage already how beneficial it's going to be for the winners, they're going to continue up to the right. Like, I'm not even including Broadcom, Astera Labs, Oracle. Like, these companies are just having this insane opportunity that is in the second inning of a baseball game, that I think that is providing a high floor on any kind of pullback, because we saw this very early. A lot of people were off sides on the AI play. They were just like, it's early. A lot of these names are catching bids. Like we don't feel comfortable yet. There's too much geopolitical tension. So they were like on pause on the sidelines, waiting for major black swan event to happen. It just never occurred. And guess what happened? These winners just continue proving every 3 months why they're winning, and went up to the right, no pullback. So now a lot of institutions are on the sidelines because they aren't owning these names. And if you're selling a book and your people are paying you fat fees and they're saying like, why don't you own any of these AI names? Like, why is Joe Schmo in the basement outperforming you by 2 to 3x because they went in on AI and you didn't? What am I paying you for? That is some of the questions that are being answered right now. And I think that there is somewhat of the visionaries paid good value for these winners, and now the institutions are paying the premium to own those same names.
Is there a chance though that we could actually be even more simple about why we're seeing the market? Is it just we've gone from great uncertainty and a rapid capitulation to the next leg up? You know, I keep saying that capitulation is going to happen faster than ever because the speed of the algorithms and the AI and the trading and the sell-offs happen at just incredible force.
Yeah.
But at the same time, the stairs/escalators up, it came back to some extent when, you know, because there was like this phase. It was like the first phase was like we realized that this tariff thing's a little crazy, but they are going to negotiate. Like there's some willingness. It's not just like all on. And that kind of, you saw the first wave of recovery. And then there was kind of like this, but you saw the Atlanta Fed, it's going to be GDP shrink. Tariffs are going to find their way into the economy over the next couple of quarters. You know, inflation's going to explode. All the things that we thought were going to happen didn't happen. And so now you get to the point where after a couple of quarters of relatively strong earnings, continued demand in endless kind of, I need more GPUs. We can't create enough capacity. You're hearing all this. Like when all of this kind of continues to happen, you start to say, I think we might be all right. And then basically now though, you got people like, oh my gosh, I've been on the sidelines, like, and my money's not been working for me. And now it's almost like chasing. And that's why I say like people like us, we're sort of, you know, we're willing to put your proverbial, you know what on the line, your neck on the line to buy in April and go big when everybody else was sort of running, have been rewarded. But I also do think this is like one of those moments where there's a little bit of that feeling of, when everybody's greedy, be wary, and everybody's wary, be greedy. Yeah. I'm not bearish at all about AI. All I'm saying is I'm just kind of coming to the conclusion that how long can a run go this hot? And by the way, it can go for a while. Like the market can definitely outlast your willingness to be short, that kind of thing. Like, rationality of the market. But I do think we've had a great run. I'm kind of looking to see a correction at some point. And actually I'm kind of here for it. Having said that, there is a very realistic chance this could run all the way through the end of the year. There's just so much sort of exuberance and euphoria right now. Everybody feels great. The rates are dropping. The numbers are largely good. The job numbers are my biggest concern. The jobs don't look super great. And the revisions have made it look even worse. But I still think this is a really strong economy. And most of what we were told was going to crack hasn't cracked. And, it's like you can't be on the sidelines forever.
Well, first off, to tackle one of your points, like the market pullback, I'm on the same camp. Like the RSI is at a 75 on the daily on SPY and QQQ. Like we are anything above 70 is overbought. We are absolutely overbought right now in the market. But so when we say like a pullback, I think what him and I are both agreeing on is a cool off, not really a 10+% pullback. I think it's going to be like 5%. And I think that another factor of like kind of what's the job market, like why it's not causing any kind of squeamish reaction. Because typically we had those kind of job numbers in a September, especially, there would be a sell-off. Like there absolutely would be. But I do believe that AI is providing some kind of a band-aid in that, because the ISM, for example, the employment index, that came at like a 44. It was the lowest since the pandemic.
On the manufacturing index?
Yeah, the manufacturing index. That alone would cause a automatic red flag in September sell-off. Yet this year, the equity markets shrug that off. And I think it's because the mechanics underneath that look very different when you have AI replacing workforce. You've been very advocate about this, about the job losses that's going to come from AI. And I think this is where the AI earnings cycle layers in. Like stage one, the infrastructure. We have the hyperscalers CapEx exploding due to NVIDIA being the king. But then we also have a lot of like real revenue streams that are coming from AI, like Azure accelerating, the RPO is stair-stepping on Oracle. We have Google, Amazon embedding all this AI into their actual workflows. And then we also have tariffs that should have been a drag that cut the story short. Like instead they're kind of accelerating it because firms now see, by firms, I mean like enterprises, companies, like that automation and AI is the only way to offset these rising input costs. And I think they're realizing that they can do a lot now that they used to be able to do with certain amount of workforce. Now with AI gapping, that gap fill, it's going to permanently change them going forward. So I think that every ISM employment downtick that we're going to see, or job report downtick we're going to see, is just another data point in my eyes that dollars going to start flowing into CapEx over payroll. And that productivity gain is going to carry earnings lines for years to come.
Yeah, CapEx over OpEx. The thing about it, CapEx will certainly be, and by the way, it's turning CapEx into equity, into return on assets, return on equity. But the bottom line is that these companies are making pivot. The earnings have been good, and the thing is, these companies are showing that they can control OpEx and actually drive more earnings. And of course, CapEx, when you're looking at earnings on a non-GAAP adjusted basis, a lot of depreciation in those numbers, and the depreciation will offset and allow for better than expected earnings results, even when those dollars are being spent. Now, where those dollars come from, super interesting. Companies are going to have to you look at how little margin Oracle has based on its run rate to actually. I was pounding the table early on Oracle, but like they're going to probably. I don't know if they're going to raise debt or what they're going to do. They can't pay for all of the stuff they're doing out of OpEx. OpEx. They're going to have to actually, raise capital to build out all this infrastructure that they're building. But the bottom line is, it shows, and it's been my conversations for time, is there's just so much more capital to be raised. And whether it's something that's very sort of speculative, like you look at how our friend Niccolo De Masi at IonQ raised $1.6 billion, and put that on the books right now towards a company that's going to take many years to kind of hit that revenue ramp. So something more speculative. You look at Oklo right now, chasing $125. They don't even have revenue at this point. People are willing to speculate into industries and markets that they see because this stuff changes so fast. It's so dynamic. And at the same time, like you've seen companies get the recognition, whether it was Oracle, whether it's been Google. I was a big, advocate that Alphabet and Google was way, way undervalued. And now at $3 trillion, I think it's more fairly valued. I don't think it's crazy where it sits anymore, but like, wherever you're chasing, it doesn't matter. It doesn't matter if you're chasing infrastructure. It doesn't matter if you're chasing, basically just as long as you're not chasing applications, like SaaS. That's the one part that like is still really murky to me is, there's been a big re-rating. Some companies seem to be kind of coming out the other end, but still a lot of uncertainty there. But like energy, infrastructure, pure AI, semiconductors, all of those, if you're kind of attached to the AI trade, it's good. You got a decade, at least a Sukama decade cycle. I think a decade's kind of conservative. I don't see a situation. And we've also, a lot of boom bust cycles have been crushed. I said that the memory boom bust cycle has been crushed. Like a lot of things are going to enable a continuation of this growth. Having said that, I still think at some point you'll get a little sell-off, just because the market needs it. It's actually for the market's efficiency. There's an efficiency in the market that is required. But just like riding a hot table in Vegas, like craps, it's like you might just find yourself watching someone go on. You might pull chips down, and then you're going to watch someone go on a heater, and everyone's making money, and you're not. You just have to be willing to tolerate that for the chance of when you're going to be able to re-enter. And that's why I'd rather just buy great companies and just kind of hold them forever. That's why I largely try to do.
You just provided a lot of great points I want to talk on. First off, I think what we're describing right now is the pain trade. That's what the pain trade's happening. Why it's like kind of up to the right, where a lot of investors were just positioning for a labor-driven September correction, because every month we got a correction in our job numbers. And I think it's really important to know that the old way of viewing those job numbers is just very different now, guys. Like it really is. Like labor softness is now being reinterpreted through the AI lens, where shrinking workforce isn't a demand collapse. That's the important read through on this. Like it's the proof case for AI utilization driving the margin expansion I just mentioned, where the old reflex of a weaker NFP is kind of the start, was going to be a start of a layoff spiral, when the new reflex now of a weak NFP is the market's viewing it as the beginning of this corporate S-curve adoption, that automation is just going to absorb costs and CapEx will drive EPS leverage. And we're seeing that proof already in the earnings cycle with a lot of the major players. And I think that you have to just adopt, you have to pivot. And I think that's, again, things can happen too quickly. Like right now, things maybe a lot of forward demand is being priced in way too aggressively. And at a certain point, if we continue this trend, when earnings come in November, you have to ask what else.
AVGO hit 130.
That's nuts. It's nuts. Everyone knows we're going to need nuclear for AI to fulfill its potential, but like,
oh my God,
we're not accelerating that process, guys. Chernobyl is a very real thing. Like we're going to be
so many dollars in Viking that could have been an OCLO.
Yeah, 100%. I mean,
I'm a huge fan of calling it when I get wrong. You know what I mean? I'm calling it when you get wrong. So yeah, like I said, that's one that I'm going to be wrong until I'm right. But having said that, there is a certain amount. You ever seen those pictures? I can't remember the name of the book, but like the investment book, and it'll show the whatever headline it is, and the guy's throwing the book in the garbage can. It's like the investor's strategy book. You've seen the meme; they show it all the time. Like you're watching a company with zero revenue, zero earnings, no fundamentals, minimum contracts run away. I mean, it's like IREN, right? It's a super interesting company, but they haven't actually won any deals yet. Just the idea, though, that they're going to build this capacity, though, and we know there's this insatiable demand for capacity, and people are basically buying into the fact that they're expecting a NBIS moment. They're expecting that moment. So they're buying it at 35, expecting one day for Amazon to announce a partnership with them. And this thing, they're not buying it to go to 40. They're thinking it's going to go to 100. And so you got all this speculation piling in, and it's not a bad trade. It's not a bad name to own, but there's a very realistic chance that like the fundamentals, like CoreWeave, it's like the fundamentals will never make sense to me. It will never make sense. But the problem is like the desire to be that rational and make your investment decisions that rational ends up putting you in names like Chipotle and Starbucks, and you end up never making real money. You're like, oh, I got 8%. Like the people that are like happy to get the S&P return. It's like, if you actually are paying attention to what you're doing, there is an opportunity to get, what are you at 150% this year?
Oh, me? I'm like 400% the past
over 3 years, right?
Yeah.
But I'm saying like, so you think about that though, like how many people are happy to beat, get 10, 12% every year? And if their broker gives that to them, you're 3 times inflation. Although I think inflation is like 10% personally. I actually think you need like 10%. When you actually think about like housing costs and real input costs, like of things, especially, how much more expensive things like clothes are and stuff, they like, cool. I don't think it's 3%, by the way. I think every number and by the way, I was going to say about the numbers earlier. We were talking about like economy. I feel like President Trump has basically got us to the point where nobody believes any number ever that they're told, except the ones that he tells. Like seriously, when the numbers come out, the CPI, you're like, it came in a little hot. And you're like, and everyone just shrugs it off. It's like, he said it's bullshit, like BLS bullshit, like or on the other or on the jobs number. My point though is like really right now, every number we get, there's like the ability to just shrug it off because people are like,
because it's not the main story. It's not the main ticketing event. That's the thing. Like it's just secondary noise because
$1 trillion is going to get spent on AI stuff.
That's what I'm saying. It's like it's all show. Like it's like you're caring a lot about the like the asparagus and the mushrooms when the focus is on quality of the meat you're having. Again, that was a Texas reference. All I've had is meat on this trip. So,
but I took you for Mediterranean food like a grown up. I didn't.
So good.
Yeah,
so good. Yeah, but I do want to also caution a lot of investors because like everyone's moving with each other. And it's really important to know the pretenders and the winners. Like IonQ is clearly the tier one quantum play. Same thing with Rockwell. Like, but not even just Rigetti, like Qubit, QUBT, like that ticker. That's up like 20x. That's crazy to me. Like that's not at all anywhere close to having to catch a bid, but it's one of the handful of quantum names out there. So they're all moving with each other. So like it's really important to not let stock price dictate your narrative. Like do the research. Like right now, like, if you miss this AI trade, I can promise you it's not over. Every year, for some odd reason, we've had a black swan event. Yen carry trade crisis, the Terrafor, the bubble bursting. Like those are 3 in the past 4 years. We're gonna probably get another one next year. Like I've been talking to a lot of technicians, and they're predicting like 2026 is going to be the top of the digestion period before the next leg up. And who knows how long the digestion period is? But either way, if they're right, this is the time to read research. This is the time to build conviction in these winners that the market's already awarded. Because when there is a pullback, guess what won't change? There's still going to be the winners in the new digital economy. Instead, their stock price get reflected on some macro black swan events. And now you have an opportunity to own a part of these clear winners for this decade plus long theme. So it's really important right now to not feel that FOMO, that fire in your belly that you missed this, but use that fuel to learn more about these companies. So when the time comes, you have that conviction list. Like right now, we're rebalancing the Futurum AI 15 list right now. We are every 3 months. You guys know, like when we launched this thing, we had the Futurum AI 15 names that we believe are going to be disruptors outside the Max 7 that are going to be winners of the new digital economy. The names are changing just 3 months later. The board is moving very quickly. Earnings cycles are the door to us knowing more information, but you have to be quick to figure out who's kind of got to take the gloves off and fight each other, and who's sitting on that AI lifeboat away that's going to survive the AI tsunami. So we hopefully are going to wrap that up in a week or two. But there's going to be some exciting names that are going to be in that rebalance. I sent you we went over the preliminary list, Daniel. Like, what was something that shocked you a little on the new rebalancing of that Futurum AI 15? Like, which names landed, which names potentially left? What's the theme?
Yeah, I mean, I don't want to overly spill the beans on the rebalance. If I was kind of looking at what you were thinking, and then what I'm thinking is, I mean, I think our conviction at the top end is going to stay pretty similar. I think we were really, really right with our top 4 or 5.
Yeah.
I don't think that changed a lot. I think lower down, I think we probably underestimated the re-rating of some of the application companies, and we were a little bit more optimistic that they were going to make the pivot sooner. I actually think that they're going to get re-rated on our list because it's more uncertain. I'm still not willing to say they've been KO'd. Like, I still think there's a shot some of these companies will come through it. But I also think we have to be a little bit more aggressive and bullish about some of the energy AI plays, some of the really strong networking plays. Because I think, you may see a name like a NBIS land on our list that didn't. I can't say for sure, but 3 months ago when we started this show, I never would have made my list. There's just fundamentals weren't there. Mm-hmm. And the roadmap wasn't there. But now that you see it and you hear it and you get a validation from a company like Microsoft, it's like, how do you not look at that and say this, if you're looking for an AI play, and remember, we're trying to beat the alpha. We're not just trying to pick good names. We're trying to look at companies that have a ton of alpha. You look at, some of the names like in semis that we really liked, that we had some of them higher up on the list that were sort of adjacent AI plays, attached plays. They're good and they're solid, but they just don't have the alpha. And so it doesn't mean that they're off our list of good companies, but there might be off a list like the Futurum AI 15 when it's all about creating that alpha. So I think the rebalancing is going to be a lot more for not companies that are necessarily good or even just the revenue associated with AI, but it's the combination of companies that are good and have that sort of ability for that slingshot growth. And that slingshot and I'll be honest with it, sentiment, what does it say? Price follows sentiment, right?
Mm-hmm.
And the sentiment in some of the names that we have is still too uncertain in the first batch. The sentiment in the second is, I think we're going to have those names that can really create price discovery. The only thing I want to know is how we figure out how to put SOFI in our AI 15. I mean, can't they be in the AI? Number one on the AI 15 should be SOFI. I don't see how we don't do that. I'm kidding.
All right, we're on that topic now, SOFI, because guess what? That almost happened today. It almost hit that 30. Like, how long ago, Dano, did you predict SOFI would hit 30 in September? Was it? It was a couple months ago, right?
Yeah, like I think it was probably, as crazy as it feels, it was probably weeks. I mean, but it was basically when it was like sitting, it's because it was a short window. Like it was at the beginning of September. I just basically said, I think it could actually crack 30 this month. A lot of people are saying, not, it's going to take some time now. It had that shelf, remember the shelf? And because remember this was like totally an emotional stock for me. Because obviously it's one of my largest positions, but it had that great earnings. I mean, just an incredible earnings. And it was like, I remember I was like in the car, I was like tearing up in my eyes. It was like 6 a.m. They put them, because they print in the morning. And I'm like, you got to remember, I've been through it. I got in at IPOE. I bought that stock up to almost the price it was today, because I always believed in the mission of the company. We won't always need banks, but we'll always need banking. That was my philosophy. And so I basically, I averaged down, and I literally rode my position down from. And by the way, I had a portfolio. One of my portfolios had $2 million in it in 2022 before the fall. That same portfolio, this is how aggressive I was positioned for growth. It went to $350,000, $2 million to $350,000, and I didn't sell. I held, and it was a huge, and so I basically bought SOFI at $4, $5, $6, $7, and I amassed most of my position. Now I have not been adding. I've done some options writing on it, put spreads and stuff below the money to see if it ever comes down, I'll buy more. But and I basically averaged out at just under $10 a share. But, so basically you remember, and even as this average, I built this position, the thing had been going from like 7 to like 11, then back to like 6. And then during April, it dropped all the way down to like $6 or $7, like in that April period of time. So you're talking about a company that went from cutting back to like 12, 13, back to $7. And now it's just cracking on the door of 30. By the way,
it's discovery mode.
I mean, I'm saying this now. And if I ever change, I will come out and say this publicly though. But I have no intention of ever selling a freaking share of that stock. I think this is the next Robinhood on a price basis. This thing has the potential to do that run. And actually, if you look at the chart, and I'm not a chartist, there's a lot of even look in the charts that you put the two charts next to each other, that the SOFI stock looks a lot like the Robinhood chart before it did the rocket to $100.
Well,
and
what was
S&P. But anyway, so let me just finish this thought here, because I think 30, it's going to come. And by the way, there could be a pullback on it, but I think the fact that it's hit price discovery changes the whole complexion of what could come next for this company.
What was the price target for Noto to hit that insane bonus? Do you remember?
Okay, 45. So he's got 3 levels at 25, 35, and 45. But at 45, it's like 70% of his bonus. It's like hundreds of million. It's in the 200 million or something in bonus for him if this thing hits 45.
I remember you talked to me about it and it was like at $16, it's going to 45. There's so much incentive right now on management to get it there. I was like,
remember, they have not formally launched crypto. They've talked about what they're doing.
Yeah.
They've not actually launched their crypto product yet. Just that alone, I think will get $2 or $3. Just that one announcement when they make crypto available. And they did the private markets thing, making IPOs and private investments. They're doing a lot of really cool stuff. This is not a bank. I mean, they have banking aspects, but they are really right in between the traditional banks and Robinhood in terms of where they sit. And I think for my generation, and especially for your generation, the non-gamblers of your generation, the ones that are looking for 10 and 15% return and happy with that, I think SOFI will be more popular. It'll never compete with the traders. Robinhood owns that market, and I don't see them ever acquiescing that. But
also, I mean, the rate cut cycle beginning, it's uber bullish for SOFI. Instantly, even if it was excluding their execution, which is chef's kiss, Noto's an operator. The assumption that lower cost of capital changes everything for a digital yield bank like SOFI. When it comes to lending, investing, having deposits on one ecosystem under one roof. Like it's the same thing with Robinhood, but SoFi will benefit substantially from that part of their business, where Robinhood, I think it's more on the liquidity front, less about everything else in their ecosystem. Like the lower rates improves liquidity and it has to go somewhere. And if you look back in time, whenever rate cuts got lower or money was essentially free, like Robinhood was their first stop for retail speculation. And I think that's why it's probably catching a major bid. But dude, you nailed it. It's one that got away. It's like SoFi definitely got away from me. Robinhood definitely got away from me. That theme, that fintech theme, I was just never able to wrap my head around it and just took off.
Yeah, but, well, you've gotten a lot of them right. And there's others that you've called that I haven't, like the Astera run that you've been on, the INQ run that you've been on, like some of the ones that you've been pounding the table for a long time. So I think we both have plenty of victory laps, and we're going to have a few. We're going to get a few wrong. You're going to get a few wrong. By the way, you can be wrong by not getting in on something that was obvious. Yeah. You could be wrong by opportunity cost, not getting into something, or getting into something good but could have been better. I mean, I'll tell you this: like there was a point when I think SoFi was trading like 11, and Robinhood was 17. Okay, and I literally had thought at the time. I'm telling you what I thought. I was going to take half my SoFi position because I was frustrated. I'm like, I'm going to take half the position. I'm going to Robinhood.
Worked.
I lost $5 million by not making that choice at that time. Meaning, I still would have had a big SoFi position, and I would have done great. But I literally, if I'd taken that, I'd have made $5 million on that decision. So, like sometimes being just stubborn, even on a good name, because you can have a stock with good alpha. But, names like Palantir, like I got greedy with selling calls. I sold calls on my shares because the IV was so high, and I bought it at 9. It was in the 40s. I'm like, I could go to 50 in a month. Look at that. I can make like $1.50 a share or some nice thing. And then, on the day you sell those covered calls on your position, you're like, I made 10 grand today or whatever, your share count was. You're thinking, great. And then you watch by the end of the month, it was like 70. And you're like, I made 10 grand and I lost 200,000 in that process. Like shit like that. It's so humbling, but at the same time, like, because at the same time, if you didn't sell those calls, it would have hovered at 40 for the next 26 years. So it's like, there's like that belief in your mind, you're not going to get them all right all the time.
It's a really important behavior for investors to self-reflect at times as well. Cause I think inherently people want to they're more stubborn than they care to admit because they think their conviction is alpha. Nobody else can prove them wrong because they did the work. But I'm looking at a glass half full. Someone else who's just as put the same amount of hours into their investment case can see if it's half empty. Like there is really, really important to know all angles of your investment. Your behavior needs to change every week. Like, for me, one of the biggest mistakes I've made was I fell in love with Unity's duopoly in the gaming engine space, and I didn't give AppLovin the time of day to even consider them because I was like, I don't want two of those similar kind of plays, and I like Unity's optionality with that duopoly mo. Look at the last 4-year performance. Who's the schmuck on that? AppLovin. AppLovin should have been my go-to when I saw proof in the pudding. Daniel, I'm sure he has experienced in his career where you got to be a little more flexible than you care to admit, and he dipped his toes in with the Robinhood thing from SoFi. Sure, he could have made more alpha, but he still made a lot of more.
In fairness, I did buy Robinhood later. I didn't sell any SoFi. I bought Robinhood at about $30.
Yeah.
And I've held it. And I mean, my position's like 10% of the size of my SoFi position, but it was probably more like 2% when I bought it. So, I mean, it's been a great one. I mean, look, advising so many tech companies, there's a lot of companies I can't buy. Like I have great insights on names. Like I couldn't buy NVIDIA, I couldn't buy Oracle, I couldn't buy Broadcom. Hopefully some of the people out there listen to our kind of our conceptual viewpoints on those companies and learn something and used it maybe to make their own investing decisions. But so I've had to pick themes. I had to find themes and things I believe in. So like I believe in personalized medicine. I believe in the weight loss fad. Like I do believe that being healthier creates a ton of gravity for companies that can make people healthier. I believe in, democratization of finance. And so these are themes I've gotten behind, and that's why I've kind of held these positions that I've held. But there's a lot of things I couldn't buy, like pounding the table for NVIDIA at a split adjusted $30, Oracle at $70, Broadcom at, 100. Just like so many companies that were so obvious to me. And I never couldn't own them or never owned them. And so, we're all humbled at times by our investments. And so, yeah, I think that self-reflection is important.
I mean, my goal is always 20% CAGR. Eventually I'm not going to hit that. And I think a lot of people should be assuming like the year you guys have had past couple of years, like it's not the reality. That's what scares Daniel and I, because I think a lot of folks' perception has changed a bit in the past couple of years, especially with alpha and creating performance, where people shrug now off of a 20% CAGR portfolio. Like that's elite, guys. Like long term, that's absolutely elite. Now it's like, oh, that's it. In the teens, you're outperforming the market still, but by 1 or 2%, that's it. That's why it's a little dangerous. But either way, let's get back to.
Do you think you could always or probably always beat these numbers if you're kind of running your own book? Because when you're investing other people's money, right, and you're versus investing your own money, there's like,
Ooh, that's a good question.
Like a lot of money managers, 20% is elite, but they're investing to a sort of a promised IRR.
I think it'd be, if I was investing other people's money, I'd do more pair trades to de-risk myself. So like if I'm long this, I should be short something else. So I'm at least like more, again, like how you run a hedge fund. Like if I'm long,
maybe if like long IonQ, you could be short Quantum Computing Inc.
Exactly, just like that.
Like I'm not only because I believe this is the winner and this is the loser, and I'm gonna,
totally. Or I'm long healthcare names. I'm going to short AI networking names because they're freaking going bonkers right now. And I think
overvalued.
They're overvalued. Like that's a pair trade. Like I think.
Oh, how's that Citron guy doing with his Palantir short?
Have you heard from him? I think he.
By the way, you should probably do a proof of life check on your friend Shkreli. I mean,
oh my God,
he's IonQ short.
Yeah, I mean, it's very important to know who's playing a character, guys, and who's actually real. Like, I think the Citron guy, especially, like, he was in every outlet every single day, multiple times a day when he released that. Have you heard from him in the past couple of weeks? I haven't seen one thing. I think his name's Left. I don't know what his name is.
Andrew Left, I think. But yeah. like I'm just saying, like, there's some of these people. It's like, by the way, some of their theories and their theses may not be wrong, but God, they had to have lost a lot of money in the process of wanting to be right.
It's also
it was like some of the marriage advice I gave you, right? Let her be right. You'll win. You win. Let her be right, Shay. Show everybody the ring. Show everybody the ring. Married Shay.
Look at that.
Is that the same one you wore when you were engaged? Or
no, this one's more circled. It's more a little roundy.
Yeah, I'll just check in about everybody knew about his engagement ring.
I will say that going back on that point, I'm sure everyone else experiences this in their normal life. Like it's way easier playing the villain and being like a certain negative way than it is taking the high road of like, I'm right long term, but a lot of the catchy phrases, it's easy to generate FUD. Like a lot of these bears they come to light every single time the VIX hits 20 plus. They come out of their caves and just tout their chest and like, see, it's overvalued. It's like this. It's like the dot-com era. Then as soon as it V-shapes, they quiver away back in their ways and they miss some generational opportunity. A lot of them, they sell services too, which is baffling to me.
If nothing else though, like, is there something good about this sort of humanity in this all? Because like everything like I watch on X, like that isn't FinTwit related is so sad and miserable. Like people's polarized, they're miserable, angry. Like there's so much doom scrolling and rage baiting, but like in the end, like the way the market seems to work, at least indicates to me that most people want, like it's like the craps table. Nobody likes the person that plays the do not pass, and in the markets, everybody wants the market to go up. Like really, other than the people that are just looking for clicks and for attention. Like, even if people see the thesis and why the market should go down, it's like, but who wants it to? Who wants people to lose money? Who wants people to, like nobody does. Like,
I want people to be well and happy, and I want people's assets to appreciate, and I want people to go take that money into the economy and spend it so that people that aren't participating in the market have ways to participate in the benefits through other means.
So, I mean, listen, like I have 15% cash position. I've had it for 2 months. I want the market to go lower. I hate having cash. Would you be surprised to hear me say that if you see my Twitter page? I'm not going to advocate doomsday. I'm not going to advocate like my name.
No, but hopefully you pass your wisdom. Again, you're not giving quote unquote financial advice,
Yeah.
but you're passing the wisdom of your experience so that people can position themselves a little bit that way. So
yeah, totally.
I have margin call and speed dial. I saved it from the last downturn.
And look where you are now. Like you've probably made substantially more money than that the portfolio going lower in that 1 or 2 years. I mean,
I'm back and then some many times over. Yeah. But like, I mean, still, it's like I said, this is like a life lesson, the calluses of life. But like when you've been down, whether it's been financially, professionally, relationally, like you got to kind of put those, put that snapshot in the back of your mind. You got to keep it in the rear view, but occasionally just being able to see it there and be like, I came out of that. I lost 80% and it felt like the end of the damn world. But I survived and I'll survive this. And, I don't think, what's the longest bear market been over the last like 15 years since the
before I started investing. But I know that I don't know about your wife, Daniel, but for my girlfriend at the time, wife now, she always throws back, like whenever she has questions about my abilities on any financials, like, well, you went down like 70% that 1 year. So like sometimes you are wrong. I'm like, that's a very good comeback from her. I will give her that. But
she's usually just tell her she's right.
Yeah, she's right. But I will say that I think that did scar a lot of investors on missing this AI trade because they don't want to hold the bag. Like they're fearful. There's just so much noise out there. It's really hard to find that signal of like what's real and what's not real. And that's why it's really important to trust a lot of the people who back up what they're saying with actual research and what their actual conviction is. Like a lot of times people just they act in a sheep manner. Like Google is a perfect example. It was so easy to follow the narrative that AI is going to disrupt search. Search makes 90% of their earnings. Why would you invest Google? And you just quit from there. When if you just looked under the hood, there's layers underneath Google. Search is one of them, but the rest are hardening on the infrastructure side. And that's a far greater opportunity than the information retrieval moat they have right now, aka search. That's a classic example. And again, right now, like Google's at nonstop for 11 straight weeks. Like it's kind of a crazy move. Not much is happening except the price action. Like Daniel said, it falls price action. But I know we're at the end of the time here. Daniel, is there anything you want to close off before we end episode 14?
Oh man, it's been a heck of a week. I'm just looking across those tickers. We really did hit almost all of them. Did you want to, I know you're a big CrowdStrike guy. They had a pretty big move. I don't think you mentioned that. Do you have anything you want to say? Because I think we still believe in the cyber trade.
Oh, cyber trade is probably the safest secular growth theme you can be part of. By safe, I mean, it's just, there's a defensive component to it where it's the stickiest part of any IT budget that, God forbid something happens in a recession, it's the last to get cut. But CrowdStrike, what a monster day CrowdStrike was yesterday. I think it was a 13% day. You rarely see that in a cybersecurity name because it isn't as consumption based as like other names that just in the software space that just exceed expectation. But they had an analyst day yesterday. And I think that we've been communicating how it's actually kind of a polarizing topic if Palo Alto or CrowdStrike should be their tier one play. So we do 1A, 1B. But speaking for stocks out of Shay, I do view them as the only tier one cybersecurity name out there as pure cybersecurity name. Microsoft is still the best.
Palo.
But who? Palo is good. I just that they're the seconds behind CrowdStrike. I just don't like the land and expand model. And the reason I think
very acquisitive.
I never liked Salesforce the way they did it. But yesterday from the investor day, CrowdStrike, the surprise and why I caught such a bid, it was 20% net new ARR growth for fiscal year 2027. that was anchored. A lot of the consensus was anchored in the low to mid teens. So that was the first time management really ever offered an out year growth guide. People look at the stock price, think, oh, they must have fully recovered from the outage. That's not the case. Fundamentally, it's got a hangover. And management's been very short term about where expectations are because it's still anchoring their fundamentals. But this was the first time they kind of finally expanded it, this much more wide scope. And I think that visibility signaled to the market, and especially myself, a high degree of confidence that the pipeline health, the module adoption is what I mean by why they're tier one, because I think they have like 9+ modules that are getting adopted by customers at like an insane clip, where Palo Alto has to go acquire CyberArk essentially to create this new module for them for identity, when CrowdStrike doesn't really have to do that because they've proven to organically grow modules themselves. So I think that they're showing a lot of pipeline health, module adoption. I think that they easily can upsell because their endpoint is incredible, and usually people want their endpoint and they're going to stay in this CrowdStrike ecosystem and adopt all the other modules because of their endpoint. And it's proving to work, except for that one slip up on that outage. And I think that's another component of what makes them so.
I mean, that was a pretty big deal when it happened, by the way. That was not a slip. That was massive. But they recovered nicely.
Well, also reminded the world
sort of underperformed this year, though. Like, really, I mean, I look at it, Palo, like it's only up 13% for the year. I mean, when you look at the expected impact of AI, for instance, though, and how much cyber, like you said, Crowd had a really big one. I don't actually know what it's up year to date. Do you? I'm just pulling this up because it is on our AI 15. Oh, yeah, they're up 44%. So a much. For a company of that size and that market cap, that's a much better gain. But the whole industry, cyber, has not necessarily seen the tailwind.
Well, do you think it's because it's so not consolidated? It's just so many
fragmented.
Yeah, fragmented. Like that's they're experiencing something adjacent to the software space where like a lot of bigger cybersecurity names can just essentially create a similar product in their suite due to AI. And I think that it's a theme that everyone should be part of, but you need to be specific. And I think that there's only really 3 names. You saw Rubrik. Rubrik got destroyed on the earnings report because of one deacceleration on ARR. Like, I think it's a tricky space to be in, but CrowdStrike yesterday proved that the sky might be blue again, and they might go back to business as usual from the outage. And it's been a little over a year. And I don't know if there's anyone other than George that could have got them out of that hole that they were in. Like incredible execution on the corporate governance of that. A lot of people were claiming they're going to go to 0 at the time. Everyone's going to sue them because they shut the world down. They're at $500 now. So again, another example. Look for signal.
The memory is super, super short. I know you got to wrap it up. I will say one more thing is, the attempts to sort of raid on Oscar went unsuccessful this week. It did have a bit of a pullback from the runs up, but they did that shelf. They offered those dollars. People saw it sold hard on some of that news, and it climbed back to. It's been holding 19 as kind of a new support, and I do think that one has some upside too. Again, I look at Oscar. I mentioned on, I think, the Investing with the Boys show the other day, I initiated a position in Pfizer. These are my sort of defensive plays, but my favorite healthcare play is still HIMSS. I still love the name. I still think there's so much more upside there. And I know we didn't talk about that much on this show, but that thing's been a rocket this week too. It kind of bounced. It fell off kind of hard on some news, some supposed FDA enforcement stuff from the FTC, and it's almost back to $60. So it's finding some clear air. So all I really want to do is, before I leave, is ask everyone, buy some SOFI. I'm kidding. I'm not telling you what to do. I'm just kidding. But I mean, if it did get to 30, that would be really fun because I would love to do that victory lap.
I mean, it feels like you might have a crazy power hour, but we'll see. But again, thanks for hopping on, everyone.
Power hour. Let's go.
Go. Appreciate you guys hopping on. Until next week, episode number 15. This is episode 15 wrapped up. Have a safe and enjoyable weekend, guys.